to invite PhD candidate how to pronounce 我不知道易莫拉。
So good afternoon. Should I start?
We can hear you, but can't see you. Yes, it's okay. Okay.
Yeah, good.
Can you see me now?
Yeah.
We can see your PPT now, right now.
Okay. You mean you can see myself? You can see me?
That's okay. That's okay. We can see the PPT.
Okay. Thank you, Professor, and Honorable Chair of this dissertation session. My Honorable Professor and Supervisor, Professor Liu Haiyun, and our other designated professors, and also our my co-workers, colleagues here, and welcome to my dissertation defense. Myself, Mullah Aminul Islam. I have a Chinese name, Imola, and today I'm going to present my dissertation. The title of the dissertation is "Impact of Financial Development on Inward Foreign Direct Investment." Evidence from selected Belt and Road Initiative economies. So gradually, I will discuss why and how we discuss this issue, why and how, what are the results, what are the findings. At the very beginning, let's see a very brief sort of the total presentation. And first, I will introduce this introduction, this presentation, then a very brief about literature, theoretical framework, research methodology, and briefly I discuss the results or findings, and then the conclusions, and the last of all, publications and some references. So let's begin with the introduction part. In the background, we should say that this dissertation is about how we can how countries or how economies can attract more and more FDIs. It's in the literature that FDI is very important for the economies for many reasons. FDI is now a rich field of study in terms of theoretical and empirical studies that works as well. A great number of research studies in these fields justify the importance of FDI in economic development. And the largest number of studies is done on the relationship between FDI and the effect of FDI on the economic growth. FDI is most often seen as the blessing to the economy because it works as a transfer package from the developed world to the developing world in terms of technology, technical know-how, management capacity, and skilled human resources, trainings as well. So when this transfer package comes from developing world to developed toward to developing world, the developing world also have the spillover benefits out of these things. So it means in summary that FDI is not only about monetary flow. It also about the other spillover, the indirect spillovers. So which can help the host countries to develop its economics cycle, its human resources, and lots of other things. Also, the local farms get benefits by imitating the FDI farms. So that's the reason countries strive to attract more and more FDI. Sometimes countries change these policies, make new policies to attract FDIs. These spillover effects may be horizontal, maybe vertical, whatever is the way it's it's benefiting the countries. So the background about the FDI. we can see that since 1990s, it's not on the graph, but since 1990s, the FDI situation is you can see here. It is divided in different parts as well as the total world. The FDI inflows in the world have increased remarkably in last 2 decades. From it was 341 billion US dollars in 1995, which increased to 1.7 trillion in 2016. But maybe in recent time, 2019, it has shrunk to 1.5 trillion, maybe due to the outbreak of COVID-19 and the latter part of 2019. According to the United Nations Conference of Trade and Development of Development's primary estimates, we can see UNCTAD, the global FDI flows fall by 42% in 2020 due to the COVID-19 outbreak. But hope we can recover it very soon because there are some signs of recovery because both of Greenfin and M&A FDIs are noticed to be increasing in the third quarter of 2020. And also UNCTAD projected a reduced rate of FDIs sliding in 2021. That means this scenario is going to be over soon. So the main concentration goes to the the question how FDIs can be attracted more and more by the countries. We have seen that researchers, policymakers have taken many different ways to attract FDI. Many measures have been utilized. However, still there are many countries that are remaining less attractive destinations for FDI. So what may be the reason? The question remains why this scenario was there. Standing on this question, we studied the literature and we found that we can suggest that the reason may be underdeveloped financial system in those countries. So maybe in the aftermath of a global financial crisis, different countries put their extended endeavor to make the financial development, and they reformed the financial sector by policy and infrastructure development. As a result, some of the countries attended, developed banking system, developed financial markets, as well as developed monetary system, and it resulted into monetary ratios to GDP and bank credits to GDP. On the other hand, financial markets also developed. So due to all these, especially the underdeveloped and developed countries had developed financial systems, and these countries started to attract more and more FDIs from outer world, that means from overseas. So let's have a why FDIs is important for why financial development may be important to attract more and more FDI. First of all, it works to enhance investment. For example, Levin in 2005, he identified 5 basic functions of financial development. For example, number 1, it generates and disseminates ex-ante information on potential investment. It monitors investment projects. It ensures trading while diversify and manage risks. It mobilize and pool savings. And number 5, it facilitates the exchange of goods and services as well. So all these together make a country financially developed, and this developed country may be a more attractive destination. One researcher in 2018 mentioned that it seems useful to consider the financial infrastructure as a factor for attractiveness in multinational firms. That means it's a clear indication that financial development may be utilized as an instrument to attract MNCs, that means multinational companies or foreign investors. As per our perspective, financial development works as an absorptive capacity because it absorbs the monetary flow from FDI, and it flows into the host country economy. Also, FDI, financial development, works as a symbol of trust. It's because institutional quality, that is, institutional quality is the pillar of is the pillar of financial development. And institutional quality is represented by the socio-economic, cultural forces of the society in terms of property rights protection, investor rights protection, and general practices of the citizens in law abidance. Therefore, a country having a developed financial system, it means that it has also a good institutional quality. So when the one investor can judge that the financial system of a specific country is developed enough, he or she or they becomes sure that it has a good institutional quality. The final one is that financial development works as a source of external finance. Is necessary for the FDI embedded foreign companies, because when a foreign company comes into a host country, it may need external funds to meet its upfront fixed costs, the setup cost and other establishment costs. So where from this money comes? Maybe the financial system of the country, maybe bank borrowing, maybe the financial market, floating the shares into the financial share markets can finance the issues. So together all, if the financial system is developed, is reliable, is qualified, then the foreign nationals or foreign companies may be attracted to that specific country. So at this point, let's see about what is meant by financial development. Literally, financial development is meant by the increasing provision of financial goods and services, according to Shaw 1973. However, this definition has been a little bit extended, a little bit revised by the IMF in recent years, as IMF has developed a new measure for financial development. And according to that, we can say that we can explain as that financial development is a combination of financial institution and financial markets in terms of depth, access, and efficiency. While the financial institution depth is represented by financial sector credit to GDP, pension fund asset to GDP, mutual fund asset to GDP, insurance premium, life and non-life insurance premium to GDP. Financial institutions excess is represented by bank branches per 100,000 adults and ATMs per 100,000 adults. Financial institutions efficiency is represented by net interest gain, lending deposit spread, ratio of non-interest income to total GDP, over overhead cost, total assets, return to assets, and return on equity. On the other side, financial market depth is represented by stock traded to GDP, stock market capitalization to GDP, international debt securities of government to GDP, total debt securities of financial corporations to GDP, and total debt securities of non-financial corporations to GDP. Financial market excess is represented by percentage of total market capitalization excluding 10 largest companies, the debt issuer numbers, and finally the financial market efficiency is represented by financial market turnover ratio or the financial market capitalization ratio. I explained this issue because we utilize this measure as one of the major issue. One of the major proxy in our study. Traditionally, in prior literature, researchers utilize one or two indicators of the total 20 indicators that I have explained here. So those one or two indicator is not capable to capture the whole scenario of the financial market, because financial market is a really complex and a big and a vast issue. Only the bank financing or only measuring the capital, market capitalization ratio of the stock market is not enough to measure this issue. And previous literature majorly utilized these 2, 3, or 4, 5 ratios to measure these issues. So based on this, we have some questions in mind that is needed to be explained or needed to be explored. Number one, can financial development make a country really attractive to investors to look at their investments? I should say that this is not the first. I'm not the first to ask this question because there are some other prior person who address these questions, but maybe as per my belief, or the way of answering, I mean the way of research, didn't explore the issue fully, because they didn't utilize the good measure, a good methodology. So they had a lot of limitations, which are addressed by this research. Second one, what should be the correct speed of such development? We address this issue for the first time. As a pillar of financial system, what are the roles of institutions in enhancing FDI attraction? We address this first time. Is any minimum or maximum financial development level suggested for optimum FDI attraction? We address this first time. What are the lessons from different regions and from different development stages? This is also first time we address in this study. Is the issue of financial development comprehensively represented so far? No, definitely no. The prior studies didn't address or didn't measure financial development so comprehensively as we did here. Although it's not developed by us, it's developed by, I mean, the comprehensive measure is developed by the IMF, and we utilize the benefit. So the objectives in general we did here to find out a comprehensive proxy for financial development, which is done, as I mentioned a little bit before that, we utilized the financial development index developed by the IMF, compare the identified proxy, if any, with traditional and or frequently used proxies. Yes, we addressed this the first part of our empirical analysis, where we utilized the comprehensive measure as well as some I think 5 traditional proxies used in other studies. So we found that I'll discuss the findings later. Identify suitable sample, that is the Belt and Road countries. We'll discuss why. And the specific objective is to examine efficiency of financial development in attracting FDI, examine the role of institutions in FD and FDI. FD means financial development. Examine the potential threshold effects in respect to FD itself and in respect to trade openness, because FDI is a fact that has to go cross border. So if the one country doesn't have a open attitude to trade, I mean cross border trade, then there will be no chance for FDI or this kind of growth. So it's very important to look into the issue regarding trade openness, and we utilized it. To compare with number 5, to compare between financial development proxies, and to examine the issues in different parts of the world, maybe different regions, and according to different development stages like advanced markets, emerging markets, and early development countries. So about the sample, we did a lot of brain work to what sample countries can be accommodated, as the whole world is not suitable to be accommodated into one study. After a lot of thinking, we went for the Belt and Road countries, which is directed by, I mean, Belt and Road Initiative is directed by China, and which is declared by President Xi in 2013. Afterwards, I mean, in 2013, it was named as One Belt, One Road. Afterwards, in the Forum for International Cooperation in 2017, it was revised as the Belt and Road countries. So what are the sample? Currently, there are this bundle of countries is really emerging. I mean, group of countries. It's not the end. Maybe nowadays there are more than 130 countries are participating Belt and Road Initiative. However, based on data availability, we selected 79 countries out of those countries, and those countries are both from the Belt and the Road initiatives as well. Here are the names. Let me skip due to time constraint. So let me explain some rationale for selecting this group of countries. We mentioned already that this is a new group of countries, and this is considered as the largest project after the master plan. Sorry. This mega project covers more than 120 countries, which covers 60% of the world population. So covering 60% of the population is obviously representative. However, this 60% of the world population represents only 30% of the world GDP. Aimed at mutual development via mutual connectivity and mutual communication, I mean the aim of BRI. And most are financially underdeveloped. One common characteristics between the BRI countries, when we studied the countries' financial development stage, we found that most are financially underdeveloped, and also most are poor as well, because as we have mentioned already, that 60% population is representing only 30% of the world GDP. So these are I shouldn't say all countries. There are advanced countries, there are I mean emerging markets, there are least developed countries within the sample, but still I should say most. Then these countries connects through Asia, Europe, Africa, Latin America, and this kind of diversity and commonness between the countries make this bundle of countries as world representative. So as a representative of world, we went for this sample. So the key contributions of our study, it provides a general theoretical framework for the connection. It acknowledges the comprehensive measure of financial development. It investigates moderating role of financial institutional quality. I said already that is the first time. It investigates and identifies the threshold effects in respect to financial development itself and trade openness, and it traces the emergence of human capital development. So let's see how how the literature says. Although we have discussed already considerable things, here is the systematic review that I should skip due to time constraint. The literature was limited in addressing or in making any consensus about about the association of financial development and FDI. The proxies when used in literature was not comprehensive. It ignored institutional quality, and threshold effect also was unexplored. So here are some theoretical base. I should go a bit fast due to time constraint. So let me explain very briefly. First, I should say that there is no specific theory that directly connects these two issues, that means financial development and FDI. However, we took a new liberalized way or new liberalized, new liberal approach based on fundamental idea to construct the framework. We utilized the concepts from financial liberalization hypothesis, financial repression hypothesis, elective Ph.D., that means OLI theory, and financial motive-based approach like FDI motive-based approach like resource-seeking motive, market-seeking motive, and efficiency-seeking motives. Locational approach and gravity model, obviously, and the institutional FDI theory FDI fitness theories. So after all, we developed a framework. Happy to say that this framework has already been published in an SSA paper. So here we can see how the effect goes. Like this one is financial institution, one part of financial market. This is another. This is the financial sector as well as a whole. As there are some other control variables. So here I have shown the moderating effect of institutional quality and the threshold effects of financial development and trade openness. I presented in picture so that it can be easily visible and understandable. Based on all this, I have identified 4 hypotheses. Number one, a more developed financial system significantly attracts financial development, FDI. Institutional quality exerts a significant moderating role in the relation. The direction of FDI and FDI is positive when the financial development is up to a mark. Above that mark, it is positive, and it's also the same about the trade openness. So here are some methods. We divided this study in 4 empirical parts. I shouldn't go in details, just I presented the basic relationship here. The first one, the general empirical analysis of the effect of FD on FDI in BRI economies. This connects to our specific objective number 1, 5, and 6. I will go for the findings a little bit later. The second one is empirical analysis on the impact of financial development on FDI based on moderating role of institutional quality. It's also is connected to the our specific objective 2 and 6. One thing I should discuss, obviously, that there are 2 key reasons why I analyzed the moderating effect of institutional quality. Firstly, the financial system of a country is closely associated with the transparency, reliability of financial transactions, and contract enforcement, all of which are only possible when the country has institutions of satisfactory quality. Secondly, better institutional quality works as better absorptive capacity and can ensure investment security, which is recognized as a fair precondition for the FDI attractiveness of a country. That means whenever one company is thinking about to locate his investment into a specific country, that company will think about the security, think about the law and other conditions of that country. So the next 2 are the financial development and foreign direct investment. The threshold effect of FD in one part and trade openness in another part. I have just presented here all together. The empirical methodologies I have used is primarily I utilized POLS, fixed effect, random effect. However, fixed and random effect, even POLS, may be unreliable. The results from these issues may be unreliable due to endogeneity problems, and the results may be biased. That's why we went for instrumental variable approach, like generalized methods of moment and 2SLS. As we know that in the cases where the model suffers from endogeneity bias and where the majority instruments are not confidently exogenous, GMM works as the better strategy to resolve the issues by adding moment conditions. And also in the presence of endogeneity and fixed effects, system GMM works as a better estimator, because we know that there are two GMM estimators, system and difference GMM. So it is suggested by Bond to 002, and we utilized law and order as an external instrument, as literature says that is correlated to the financial development, but not expected to have any high correlation with the error term. So we went forward. For robustness checking, we utilized several strategies, like we segmented the analysis into financial market and financial institutions. We utilized a different estimator like 2SLS. We utilized different subgroups like Asia, Europe, Asia, Africans, Latin America, and country groups like advanced market, emerging market, and least income countries, and also alternative human capital proxy, like the labor force participation rate estimated by ILO, and the alternative institutional quality proxy was also utilized as a robustness. We utilized political risk indicators provided by international country risk guide. So for the first part, this is the basic results you can see. Just let me show you a little bit. I will explain the findings later on. And for the second part, that is where we utilize, investigated the moderating effect among financial development and FDI. So we found good indication about financial development, and also the the problems with the prior study, that means the first part, was also resolved by acknowledging accommodating the moderating effect of institutional quality. We will go for details later on. So this is the third part where we utilize the impact of threshold impact of financial development. We divided in three parts. First one, we utilize the whole financial system. Second one, we utilize the financial institution only, and third one, we utilize the financial markets only. So in all cases, we identified as presence of single threshold, and after this single threshold identification of single threshold, we divided the sample, each sample, into two parts. That means the over or above the threshold and below the threshold, which means that after this split, we analyzed again to see into the relationship, and we found a very consistent relationship among out of these justifications, investigations. And the last part, we investigated the threshold effect in regard to trade openness, and we identified the threshold value for about 4.524, and which in logarithmic form, which was in real form like 92.241 of trade openness as provided by the World Bank. The data was provided by the World Bank. So let's come to the objective, findings now. In the first part, the study found that that a developed financial sector can play a catalytic role in attracting foreign direct investment. Financial development may be contained in one of the most comprehensive proxy. It's based on the coefficients found in our study and the significance as well. And we found in the segmented study, we found a weaker effect of advanced market and low-income countries, and much higher impact in case of emerging countries or emerging market. Financial market is not much contributing to financial market. We have said that there are two parts of financial system: financial institution and financial market. So that financial market is not found to have much impact on FDI attraction, especially in Europe and African subsamples. And also we found importantly that the human capital variable was all along showing a negative impact, or that means the sign was negative. This may happen due to the unskilled, the existence of high presence of unskilled labor in all this area, or maybe the labor may be the labor force may be skilled but in a wrong trade. So therefore this issue may be resolved by training or by educational interventions. So the next part, that means the second part of our empirical study, we found that the very consistent result with the first one. The financial development is still positively and significantly was affecting FDI. The institutional quality and financial development moderation effect was found to be positive and significant. However, the third point is important here. When we utilize the financial institutional quality moderation effect, we in a previous part we found that financial market was having a very insignificant or weaker impact. But in this part, we found that when we acknowledge institutional quality, the impact was significant and very strong. And also similarly, like before, the financial institution part was also strong, and human capital also remained negative as before. And that last part, third part, we found the threshold points. For example, 0.000116 about the total financial development index. I should mention that financial development index is an index that starts from the 0 to 1. So it means that if one country have to attract more FDI, he has to. That country has to be developed its financial system above 0.116, above 0.116. And we found that in the segmented splitted sample analysis, we found that in the low financial development sample, the relationship is negative. In high financial development sample, the relationship is positive. And same happened throughout the segmented analysis as well, like the threshold point exists for financial institution index and financial market index, which was 0.2283 and 0.023. We found a similar and consistent results. Financial development is more efficient to attract FDI above the threshold point in summary. And on the segmented analysis, I have already discussed these things. So in the last part, we the key findings were like significant and a positive role of trade openness threshold in FDI corrections. And FD has higher and significant positive impact on financial development on high trade openness regime. That means when trade openness of a country is over the identified threshold point, the relationship is positive. That means that country can attract more FDI. And when it is below the threshold point, that country cannot attract that much FDI. In the segmented analysis, also we throw the though positive. That means financial market index. It was though positive, but it was insignificant. So just we should concentrate to this point that when we utilized institutional quality, then the financial market also shown its strength. But when we leave institutional quality, the financial market was showing a very weaker effect. So let's go to our recommendations based on all these findings. First one, the policymakers of all these countries, as these are world representatives, so I should say the world should consider about making financial development friendly policies. Like it can, the policymakers can identify the specific problems in regard to the access, reliability, and creditworthiness, both in regard to banks or the institutions, and both and financial market, and also resolve all these issues. However, neither of financial market or financial institutions should be preferred or should be deferred, because as we have seen or talked about earlier, that when we emphasized on financial institutional quality, all these two sides were showing their strength. So it's our opportunity to invest, or it's our opportunity to put efforts on building institutional quality of all these countries. That means law and law abidance, law enforcement, all these things. So to make more specific comments, I should say that in terms of overall financial system development, Cambodia, Cameroon, Madagascar, Rwanda, Sierra Leone, Tajikistan should be much careful about their overall financial development, whereas countries like Albania, Algeria, Bosnia, Herzegovina, Cambodia, Cameroon, Libya, Madagascar, Rwanda, Senegal, Sierra Leone, Tajikistan, Tonga, and Vanuatu should be more caring about their financial markets, while Cambodia, Cameroon, Ghana, Kyrgyz Republic, Madagascar, Nigeria, Rwanda, Sierra Leone, and Tajikistan should concentrate more on their financial institutions. These findings is based upon the analysis on the performance of the financial development of all these countries. So the next one is that the financial, the BRI policymakers should largely emphasize on human capital development. As we have seen, this is showing a negative impact. But I have another research that is not included in this dissertation, where I have investigated the role of human capital. And when I analyzed it, I found that when role of human capital is analyzed, obviously I should mention that I utilized the same data. So when I made an interaction of human capital, the interaction, the sign of human capital is showing a positive one. So based on this, I should say that the policymakers should concentrate more about human capital development, not only development, but I should say development in right direction. Right person should be in right place. And the countries should be open to overall, open to overseas trade and exchanges, at least above the identified threshold points. I should go faster. And obviously, I have some limitations while conducting these studies. Number one, it included BRI countries only, and ignores others. I shouldn't say ignore, but I utilized BRI as representative to others. Data is limited by availability because I couldn't the other data, or I couldn't consider more countries due to lack of data. Many issues might be left. That economic issues. Any economic issue is a complex one, and each one is interrelated to each other. So there may be many others that I haven't controlled over here, which is already left for the error term. So I think still I should mention it. No specific, I know that belt, I didn't specify the research direction to belt and road countries separately. That could be done by future researchers. Although the study robustly traces that traces the importance of human capital development, this specific dissertation doesn't include any such evidence or any such experiment. This research doesn't account for FDI motives. It's also the motive-based FDI is not mentioned here. Because this research is aimed to find the impact of FDI financial development on overall FDI inflows. So it doesn't account for motives. And for future researchers, based on all this, we formulated some studies. The effect and the ways of financial system characteristics, that means excess debt efficiency, it can be analyzed. The reverse relation also can be analyzed. The impact of infrastructure development, which is one of the key objective of BRI, can be analyzed. The need for human skills and the right directions or the right education modules can be researched on. Analyzed the effect of Chinese capital financial development on the other countries. Countries within BRI region can be analyzed. And the education researchers should explore the potential educational exchange as an human capital development. The relation of financial development to FDI, that means in terms of the motives, should be analyzed, I should say. And here's the list of some papers that I worked on during my PhD journey. So here are some of those indexed in good index journals, and some others are here. And so I should say show some references that I have used here in my dissertation, but this is only a part of the total references. So at this point, I should say thank you for your patience and kindly hearing my speech all over the time. Thank you.
Okay. Thanks, Yimola. So first of all, I'd like to invite Professor Luozi to put forward her comments and questions.
Okay. Thank you for your presentation. I think this paper studied the factors that the One Belt and One Road countries attract FDI, mainly discussing the degree of finance development. I think this paper is very interesting because the finance development is divided into the development of financial market and the development of financial institution. And you have done a lot of empirical works and get some interesting results. I have two questions. The first one is why the development of financial market doesn't play a significant role in attracting FDI, but the development of financial institutions have a positive impact. What's the mechanism behind this phenomenon? And I think the explanation of the mechanism in your paper is a little bit weak. And the second question is, why there is a threshold effect on trade, on the openness, and what's the mechanism behind it. I think you need to focus on explaining the mechanisms rather than just to show us the regression results. In the third, I think the format of this paper is not very standard, especially the directory and the tables in this paper. So I think you try to modify them. That's all.
Thank you, Laoshi, for your encouraging words. The first question you asked that why the financial market is not having an important effect in attracting FDI. I think the fact is behind the underdeveloped financial markets in this region. When I studied the index developed by the IMF, I found that the financial market of these countries are very poor. Even in many countries, especially in African countries, I found that there are no financial markets. So what I represented by financial market is the stock market or the bond market, all these things. So in many countries there are no standard stock or bond markets as well. So that affected as a total in our findings. And about the mechanism, thank you, Laoshi. I'll try to improve it. I will also talk to my mentor about it, and also focus on the mechanism of trade openness to effect on FDI. Thank you, Laoshi, for these comments. And also I'll correct the format.
Okay. First, thanks. The next, I'd like to invite Professor Fan Hongzhong to share with us his comments and questions.
Thank you, Chairman. I think you have done a lot of work to research the relationship between financial development and FDI, but I think this topic is not easy. It's not very easy to research because you know that the endogenous problem is difficult to overcome. You use many methods to overcome endogenous problems. But why do you, I have two questions. One is, how can you prove financial market development, financial institution development is a good instrument variable? How do you prove financial market development, financial institution development is a good institution variable? The second question is, if you think financial development is endogenous variable, and you treat endogenous problems in chapter 5. Why don't you treat endogenous problems in chapter 6 and chapter 7. And the third question is, I want to ask you the third question. The third question is, which results do you believe more convincing? In chapter 7 and chapter 6 and chapter 5. Which result is more convincing, do you think? Okay, please answer me.
Thank you, teacher, for your judgment and your questions. So let me answer one by one. I think at the first one, you questioned about how I judge my the goodness of my instrumental variables. So as I mentioned here in presentation and also in my dissertation, that I utilized law on order situation. That means there is a separate indicator of measuring law and order that's provided by ICRG. So I utilized this as an external instrumental variable. Beyond this, I utilized the lag dependent variable as an instrumental variable and other moment conditions as instruments. So when I produced the results from regression, I found that the Hansen test and the Sargan test and the autocorrelation tests are showing that these instruments are good and fit for studies. The results are appended in the dissertation. And also about the variable law and order, I have shown in my presentation, discussed in my presentation as well, that the literature says that the law and order is more related to financial development, not it's not supposed to be more relevant to the error time. So the literature has some references as well. The second one is about how you asked that why I have treated the endogeneity problem in chapter 5, why not in chapter 6 and chapter 7. Actually, Laoshi, I have treated in all chapters starting from 5 to 8. But I have discussed about endogeneity issue only in chapter 5 because these 4 studies are interconnected. It's coming one after another sequentially. So maybe some issues I discussed earlier, and if I discuss this again in next chapter, it will be a mere repetition of previous discussion. So I avoided discussion in later chapter. Otherwise, I should say that I addressed the endogeneity issue in all chapters, and I utilized the methods like GMM and in 2SLS, like these issues. Like this instrument. Tools. And which results do you believe more? Yeah, it's an interesting question. Thank you for the question. I believe that the results I found in chapter 7 is more interesting because the results in chapter 5 is a mere general or baseline study that gives us the base that there is a connection. Chapter 7 gives us a more specific result that how FDI is affected by FD on the specific threshold point. So once we identified the threshold point and divided the data into 2 regimes, that means above the threshold point and below the threshold point, we found that above the threshold point, the the effect of FD, I mean financial development on FDI is strongly significant and positive, while below that threshold point it's strongly negative and significant. So from here we can it was same for financial overall financial development, financial market development, and financial institutional development for all the parts. So from this conclusion, we can get assured that the countries should endeavor to be financially developed at least above that identified threshold point. I hope I could explain.
Okay. So if there's no further questions, I'd like to invite Professor Long to share with us her questions and comments.
Okay, thank you, Professor. Thank you, Mola. Okay, so I also have a question about your IV, the approach. You said that this is your main primary approach. I think you may need to spend more time to convince us that the variable you choose, law and order, is a proper proxy for this problem, because I can see, I mean, law and order is also connected. It is also related to some characteristic of a country. I mean, the question is very complicated. So you may need to spend more time to ensure us that this is a good choice. And also, I suggest you to include this variable into your abstract, because when I read your abstract, I expect to see what is the proxy you used in your paper, because this is very important. Okay, so this is my first comment. And also I have a question, which is when you talk about the moderating effect of institutional quality, I have a concern here, because I think when we say an institution, financial system is part of the institution. It's a very important institution. So this institutional quality may already include the measurement of the quality of the financial system. So it would be slightly weird if you to see the moderating effect of this institutional quality. So maybe you can tell us something about the measure. So how you measure institutional quality? Okay.
Should I answer?
Yes.
Thank you, Loshi, for your very constructive and effective comments. The first one you talked about the instrumental variable. I'll definitely go spend more time to explain it more and include it in my abstract. The second one, I should explain that this moderating effect of institutional quality and the institution about financial institution, these are two totally different issues. This institutional quality is relevant to the law. I mean, the institutional base of a country, that is, I should say, let me show you. I explained already. This institutional quality actually is not a part of this institution. It's more relevant to. I mean, it's not more. It's totally relevant to the socio-economic culture of one country. That means how the people of that country is connected to. I mean, how the people of the country is connected to law and law enforcement agencies, how the country protect the contracts enforcement rights, how the country protects the investor protection rights, all these issues. There are a lot of other issues as well. How for example, how the government quality is, how the bureaucratic quality is, how the government stability is, how the rules of voice and accountability is, all these things. So these institutional quality and financial institutions are totally different. So I hope that I could make you understand.
Okay. Thank you. Then I have no other questions.
Thank you.
Okay. And I think you have done a quite comprehensive empirical analysis about the financial development and the FDI within the Belt and Road country systems. I had just one brief questions. I noticed that you when you ran the regression with respect to the FDI, you always put a negative the FDI variable into the regression. So is there any specific reason for you to put a negative FDI variable into the regression analysis?
Thank you, sir. There are two specific reasons for putting lagged value on the analysis. Two. The first one is that how should I say, the FDI, that means the FDI in 1 year has definitely, the literature says that the FDI in 1 year has some effect on the FDI on next year. That means the FDI on this year is affected by FDI in last year. That means the lagged year. It's because when a multinational company invested to a specific country, for example, in China, maybe in next year, the multinational company, that company will invest more, or the other companies will see the example of that specific company, and they will be interested to invest into China or any specific country. So lagged investment, lagged FDI is important to be judged. This is called a retrospective effect. And the other one is that I utilized GMM, and I also relied on the results from GMM. That means generalized methods of moments. So as per GMM, as per the methodology, it requires to utilize the lagged value of the dependent variable. So these are the two specific reasons.
Okay. So I understand. So no further questions. So you can have a rest, and we move to the final PhD candidate. Okay.
Oh, thank you, Laoshi. Thank you, Laoshi. All.
Okay.
Hey, Jinping.
Hello.
Yes, you can
Yes.
start.
Hello. Good day. Oh, okay. Hello. Good day to you all. I am presenting to you my thesis with the title, Effectiveness of Natural Resources Policy in Transition to a Green Economy in the Lake Zone of Tanzania. This one is the content of my research, introduction, problem statement,